So today is Tuesday, April 28, 2026. And honestly, inflation is just soaring. We've got a massive conflict that just blocked like 20% of the world's oil supply.
Yeah, it's about.
And the Federal Reserve is completely trapped. I mean, totally cornered.
Absolutely cornered.
By all historical logic, the price of gold should be, skyrocketing today. But instead, it plummeted.
Right, which makes 0 sense on the surface.
Exactly. And to understand why the ultimate financial safe haven just failed, we actually have to start thousands of miles away. In Silicon Valley, of all places, with a $600 billion receipt that OpenAI can't quite seem to pay.
It's just one of those rare days,
Yeah.
where the market completely exposes the invisible wiring that connects everything.
Yeah.
You pull on a thread in artificial intelligence, and suddenly a shipping lane in the Middle East unravels.
Yep.
Which then, of course, forces a massive boardroom decision in Washington.
And that invisible wiring is exactly what we are going to expose for you today. We are pulling together insights from a really massive stack of sources for this deep dive.
We've got a lot to cover.
We really do. I've got a sweeping strategic analysis of global markets that just hit my desk. We have live reporting from Kiplinger and WDRB.
And the corporate earnings data, too.
Right. Incredibly granular corporate earnings breakdowns from Chartmill, plus some really fascinating metals market analysis from Gold, Silver, and the Motley Fool.
You really need a wide aperture today. I mean, if you just look at the tech tape or just look at crude oil futures in isolation, you are completely missing the actual story.
The big picture. So our mission for this deep dive is to connect the dots between three massive, tectonic plates that are shifting simultaneously today.
All at once.
First, a stunning reality check for the AI boom. Second, a historic fracturing of the global energy supply chain. And third, this incredibly tense changing of the guard at the Federal Reserve.
It's a perfect storm.
It really is. So whether you are tracking a tech-heavy retirement portfolio, or maybe you're just wondering why gas just blew past $4 a gallon, or trying to figure out if this whole AI hype cycle has finally peaked, we are going to give you the structural why behind today's absolute economic whiplash.
The real mechanics of it.
Exactly. Okay, let's unpack this. We have to start with the undisputed heavyweight champion of the stock market over the last 3 years, which is technology.
Right.
Today, the engine didn't just sputter, it violently backfired.
It was a brutal session. I mean, specifically for the semiconductor and the infrastructure layer.
Yeah, the numbers paint a really interesting picture because it wasn't a universal crash, right? The S&P 500 fell 0.49% to close at 7,138.80.
Which, let's be real, is still incredibly high.
Yeah, let's keep some perspective for sure. That is still its third highest close in history. It's up 23.45% since the 2024 election.
Right. The broader market is holding up.
But the NASDAQ, which obviously carries the weight of all those tech giants, it took a much harder hit. It was down 0.90% to 24,663.80. And the catalyst wasn't an interest rate hike or, a regulatory fine.
No, it was a piece of journalism.
A blockbuster investigative report from the Wall Street Journal regarding OpenAI.
And that report, it essentially pierced the veil of invincibility that has just surrounded this whole generative AI narrative for years now.
Yeah, totally.
Because the market has been operating on this assumption of infinite exponential growth for user adoption. And the journal's reporting suggests that, well, the curve is actually flattening.
Significantly flattening. The headline that sent shockwaves through trading desks today is that OpenAI reportedly failed to reach a critical internal target.
A massive target.
1 billion weekly active users for ChatGPT by the end of 2025. They missed it.
Getting to 1 billion weekly active users is just a staggering ambition. I mean, for context, it took Facebook nearly a decade to reach that kind of scale.
Right.
But in the valuation game that OpenAI is playing right now, 1 billion users isn't just a vanity metric. It's a strict mathematical requirement.
Which brings us to the second, and I think much more alarming part of the journal's report. OpenAI's chief financial officer, Sarah Friar, allegedly warned the company's leadership that future computing contracts could be in serious jeopardy.
Yeah, that's the part that really spooks investors.
Because the underlying issue is that they aren't seeing the accelerated revenue growth required to justify their massive data center investment program, which is $600 billion.
Let's hover on that number for a second. $600 billion.
It's hard to even comprehend.
We toss these figures around so casually nowadays, but we really need to ground that in physical reality. That capital expenditure isn't just, buying some software licenses.
No, it's heavy industry at this point.
Exactly. It's buying miles and miles of specialized NVIDIA server racks. It's securing liquid cooling infrastructure that requires massive municipal water rights. And they're signing these decades-long contracts for gigawatts of dedicated nuclear and natural gas power.
So I'm really struggling to visualize the economics of this. I mean, I understand buying the servers, sure. But at 600 billion, it feels like they are building a parallel electrical grid just for compute.
They essentially are. And that is exactly where the concept of the monetization gap comes into play.
The monetization gap.
Right. The market is transitioning out of this era of momentum-driven exuberance. And we are entering a phase of clinical ruthless scrutiny regarding actual cash flows.
Show me the money.
Exactly. The people financing this massive build-out are looking at the math, and they're asking a very simple question. Can $20 a month subscriptions and enterprise API calls actually pay off a $600 billion infrastructure mortgage?
Wow. So if we look at this historically, is this like the late 1990s telecom boom?
Oh, that's a perfect comparison.
Because, companies laid millions of miles of incredibly expensive fiber optic cable across the ocean, and they were assuming the internet traffic would just immediately justify the cost.
Right. They built it assuming the users were already there.
But the infrastructure was built years before the consumer demand actually caught up. And all those telecom giants basically went bankrupt, even though the internet itself obviously wasn't a fad.
That is the exact historical parallel. The fiber optic cables had to be laid down for the modern internet to even exist, just like these gigawatt data centers have to be built for frontier AI models to function.
Right.
But timing is quite literally everything in finance. Yeah. NVIDIA is the one selling the fiber optic cable today, essentially, and they are getting paid right now.
Cash in hand.
Yes. But OpenAI and Microsoft are the ones trying to collect the toll revenue from the users. If that toll revenue is only growing linearly, but the infrastructure costs are growing exponentially, well, the math eventually breaks.
And we should definitely note that CEO Sam Altman came out swinging today. I mean, he called the claims in the report quote-unquote ridiculous, and he insisted they are still aggressively acquiring as much compute as physically possible.
He has to project that confidence.
But looking at the tape, Wall Street completely ignored his denial, didn't they?
Totally ignored it.
Yeah.
Because the collateral damage in the semiconductor space tells you exactly what institutional investors are really thinking right now. They are de-risking.
Big time. NVIDIA slipped 1.45%. Intel was the most active stock of the entire day. Over 143 million shares traded as people are just trying to figure out if it has finally found a bottom.
People are definitely bargain hunting there, but it's risky.
But the real bloodbath was in the specialized networking and memory components. Rambus dropped over 21% in a single trading session.
21%. That's a massive haircut.
Yeah. So why would a peripheral company like Rambus get cut in half on just an OpenAI user growth rumor?
Because of where the bottleneck in AI training actually sits right now. Right now, the constraint isn't just the processing power of the GPU. It's the memory bandwidth.
Okay, break that down for me.
So moving terabytes of data in and out of the processor fast enough requires highly specialized memory controllers. And that is exactly what Rambus licenses. So if a $600 billion data center build-out gets paused or even delayed by 18 months just because OpenAI needs to let their revenue catch up, the orders for those specific memory components evaporate instantly.
So they're the canary in the coal mine.
Exactly. A 21% drop shows you that these specialized hardware stocks were priced for absolute uninterrupted perfection.
Which sets up a really massive showdown for the next few weeks because we are heading straight into mega cap earnings. Amazon, Alphabet, Meta, Microsoft.
The heavy hitters.
Yeah. And the strategic analysis report I was reading makes it very clear. The market is no longer going to reward vague statements about, future AI capabilities.
No, the grace period is officially over. Investors want to see AI-driven margin expansion.
They want the proof.
Right. They want a clear line of sight showing that implementing these large language models into Amazon Web Services or Microsoft Azure is actually lowering operational costs, or that it's generating net new, highly profitable revenue.
So if the earnings calls just feature executives talking about new data center investments without corresponding revenue spikes,
you will see a severe, rapid rotation out of tech.
And we actually saw the leading edge of that rotation today. I mean, capital didn't just evaporate, it moved.
Money always goes somewhere.
Exactly. While tech bled out, the energy sector rallied really hard. It closed up 1.4%. But here is the fascinating twist. Investors aren't piling into energy because of some brilliant new technological breakthrough in oil extraction.
Not at all.
They are piling into energy because a geopolitical earthquake just basically shattered the global supply chain.
Yeah, we moved from a reality check in Silicon Valley to a literal crisis in the Persian Gulf. And the implications of what happened today are going to dictate global economics for the rest of this decade.
So let's lay out the facts on the ground for you. Today, the United Arab Emirates shocked the diplomatic and financial world by announcing its withdrawal from OPEC and the OPEC Plus coalition.
Massive news.
Huge, and this takes effect on May 1st, 2026. The UAE has been a member since 1967. This isn't just a minor policy disagreement. This is a foundational pillar of global energy management just collapsing.
To really appreciate the magnitude of this, you have to look at what OPEC actually does. For half a century, OPEC has acted as the central bank of oil.
Right.
By utilizing a strict quota system, they managed the supply of crude to smooth out price volatility. So losing your third largest producer, a producer with massive, state-of-the-art spare capacity, by the way, it essentially signals the end of the managed supply era.
But the timing is what makes this so incredibly explosive. The UAE isn't doing this in a vacuum. They are doing it in direct response to the blockade of the Strait of Hormuz.
Right.
Because of the ongoing conflict involving the U.S., Israel, and Iran, the strait remains completely shut down. And that narrow strip of water handles roughly 20% of the entire world's oil and gas supply.
It's the ultimate geographic choke point. The shipping lanes are only 2 miles wide in either direction.
Just 2 miles.
That's it. And with the current military escalation, maritime insurance premiums, specifically war risk premiums, have become so astronomically expensive that commercial tanker traffic has effectively just ceased.
Nobody can afford to sail through it, and that blockade is economically suffocating Abu Dhabi. The numbers from the WDRB breaking report are just staggering. The UAE's oil exports have been choked down from 3.4 million barrels per day to just 1.9 million.
Which is agonizing for them. I mean, the UAE has spent tens of billions of dollars over the last 5 years aggressively expanding their production capacity at fields like Upper Zakum.
They built all this infrastructure to pump more.
Exactly. Their stated strategic goal was to achieve a production capacity of 5 million barrels per day by 2027. They have the wells, they have the infrastructure, but they are sitting on stranded assets right now.
The analysis calls it wearing Saudi-led handcuffs.
That's a great term for it.
Yeah, because Saudi Arabia typically favors lower overall production to keep prices elevated, which funds their own massive domestic infrastructure projects. But the UAE sees the long-term writing on the wall regarding the global transition away from fossil fuels.
I want to cash out.
They want to monetize every single drop of oil they have while it's still highly valuable.
And by leaving OPEC, the UAE is declaring strategic independence. They are saying to the market, look, the second this blockade is lifted or the moment we finalize alternative overland pipeline routes, we're opening the taps completely. We are no longer suppressing our output to subsidize our neighbors.
But hold on, let's play this out mechanically. If the UAE is leaving OPEC, specifically so they can pump more oil, and we are looking at a future where they flood the market with 5 million barrels a day, shouldn't traders be dumping oil contracts?
You would think so, yeah.
Shouldn't the expectation of massive future supply drive prices down today? But instead, WTI crude blew past $100.09 today, and Brent crude broke $111.
It's a really great observation, but it highlights the severe disconnect between the futures market and the physical cash market.
Okay, explain that difference.
Yes, in 2027, an unconstrained UAE might push prices way down.
Yep.
But a refinery in Germany or a power plant in Japan, they cannot burn a 2027 futures contract.
Right, they need the oil now.
They need physical barrels of crude delivered this week.
Right, because of the blockade.
Exactly. When 20% of global supply just vanishes overnight, you enter a state of severe backwardation. The immediate localized shortage is so acute that buyers are willing to pay massive premiums for physical delivery today.
Just to keep the lights on.
Yes. The strategic reports indicate that in certain European hubs, the cash price for a physical barrel of oil is currently trading at a 50% premium to the Brent futures benchmark. Traders are pushing WTI and Brent over $100 today because the UAE leaving OPEC adds immense long-term volatility to an already panicked, heavily constrained system.
And the clock on this localized shortage is ticking louder every single hour. The intelligence estimates suggest Iran is projected to run out of domestic storage capacity for its unexported crude within 12 days.
That is the ticking time bomb of this entire crisis.
So let's translate that into physical reality. What actually happens on day 13? I assume they have a fleet of very large crude carriers just anchored off the coast, full to the brim. When those ships are full and the onshore tanks are full, what happens to the actual oil wells?
They have to physically shut them in. They have to stop the flow of oil at the wellhead.
You can't just turn it off, can you?
No, an oil well is not a kitchen faucet. You don't just turn it off and on. When you stop the flow of a pressurized reservoir deep underground, you change the physics. Paraffin wax can build up in the piping.
Oh, wow.
Hydrogen sulfide can cause severe corrosion. Sand can shift and block the perforations in the casing. If Iran is forced into mass shut-ins, some of those wells will suffer permanent reservoir damage. They will never produce at the same volume again, even after the blockade is lifted.
Which means this isn't just a temporary delay in supply, it's a permanent destruction of future capacity.
Precisely, which tightens the global market for years to come.
And the diplomatic off-ramp seems completely blocked right now. We have the latest reports on the negotiations. Iran essentially offered a quid pro quo to reopen the strait.
And what did they offer?
They offered to unblock the shipping lanes if the U.S. lifts its naval blockade on Iranian ports. And, crucially, they demanded that any talks regarding their nuclear enrichment program be completely deferred to a separate, later date. Classic decoupling strategy. Fix the immediate economic crisis today and just ignore the long-term security crisis.
Exactly. But the U.S. completely rejected it. Both President Trump and Secretary of State Marco Rubio held a really firm line. They stated that nuclear nonproliferation cannot be decoupled from the regional security architecture, and it must be addressed immediately as part of any agreement.
So neither side is budging.
Right. So the diplomatic stalemate remains, the oil remains blocked, and the consumer pays the price.
And that price is immediate. And it is painful.
Very painful. U.S. gas prices just soared to a national average of $4.18 a gallon today. In heavily populated areas, it's pushing well past $5.
Which is just crushing for household budgets.
Yeah, that isn't a trailing indicator. That is money vanishing from your checking account this afternoon. Which brings us to the third massive tectonic plate shifting today, because that $4.18 gallon of gas is feeding directly into a nightmare scenario for the Federal Reserve. It's the ultimate transmission mechanism. A geopolitical standoff in the Strait of Hormuz directly dictates the interest rate on your credit card and the mortgage rate on your house in Ohio.
Exactly. And today, April 28th, is day one of the FOMC policy meeting. And the atmosphere in Washington is electric because this is Jerome Powell's final meeting as Fed chair before his term ends on May 15th.
And the drama surrounding his exit is honestly worthy of a political thriller.
It really is. Just days ago, the Department of Justice officially dropped its investigation into Powell regarding the cost overruns on the Mariner S. Eccles building renovation.
Right, that was hanging over him for months.
By clearing that investigation, it removes the political roadblock for the Senate to confirm Kevin Warsh as the incoming Fed chair tomorrow. But Kiplinger pointed out a wild historical wrinkle here. Powell's term as chair ends in May, but his term as a member of the Board of Governors doesn't expire until January 31st, 2028.
Meaning he has the legal right to step down from the head of the table, but remain in the room as a voting member.
That would be so awkward.
Extremely awkward. He could stay on for nearly 2 more years, acting as this massive institutional counterweight to Warsh. And the irony is incredibly thick because the last person to do something like that was Mariner S. Eccles himself, the very man whose building renovations sparked the DOJ investigation.
History doesn't repeat, but it definitely rhymes. So we have this intense boardroom transition happening, but the actual policy decision coming out of the Fed tomorrow is considered a 100% lock. The futures market expects them to hold interest rates steady at 3.50 to 3.75%. There will be no cuts.
Their hands are completely tied.
Let's look at the data that tied them. March CPI came in blazing hot at 3.3% year over year. That is a massive problem when your stated target is 2%.
We know exactly what drove it.
Right. What drove that number? A 21.2% spike in the gasoline index. Almost 3/4 of the entire monthly increase in inflation came strictly from the energy shock. Meanwhile, the domestic economy isn't breaking. The labor market added 178,000 jobs in March, and unemployment is holding steady at 4.3%.
We have sticky, energy-driven inflation layered over a really resilient labor market. That is a textbook recipe for holding rates high.
And the bond market knows it. The 10-year Treasury yield hit 4.352% today. We are officially cementing the higher for longer era.
Which brings us to probably the most important economic concept of the decade. If you want to understand why the Fed is truly trapped right now, you have to understand fiscal dominance.
Break down the mechanics of fiscal dominance for us, because it sounds intimidating.
It does,
Yeah.
but it's actually pretty straightforward. In a normal economic regime, a central bank uses interest rates like a thermostat to balance inflation and employment. If the economy runs hot and inflation spikes, they raise rates to cool it down. If employment crashes, they lower rates to stimulate borrowing.
Right, that's central banking 101.
But under fiscal dominance, the sheer size of the sovereign debt overrides the thermostat entirely.
Because the U.S. national debt is approaching $40 trillion.
Exactly. When the debt is that astronomically large, the government's own interest payments become the dominant force in the entire economy. It's like trying to brake a speeding car, but your brake pedal is accidentally wired to the accelerator.
Wow.
If the Fed raises interest rates today to fight this $100 oil inflation, the Treasury's cost to service that $40 trillion debt explodes. We're already at a point where annual interest expense exceeds the entire defense budget.
Which is terrifying.
It is. Pushing rates higher balloons the federal deficit, which requires the government to print and borrow even more money, which ironically pumps more liquidity into the system and can actually cause more inflation.
So raising rates actually feeds the beast. But if they cut rates...
If they cut rates to lower the government's borrowing costs or to prevent a recession, they risk letting that 3.3% inflation catch fire. With the Strait of Hormuz blocked, a rate cut would signal to the market that the Fed has just surrendered to inflation. The dollar would collapse, and the price of imported goods would skyrocket.
So the brake pedal accelerates the car, and taking your foot off the gas lets the car roll off a cliff.
That's the trap.
So they do nothing. They just hold at 3.50 to 3.75%.
They hold and they pray for a diplomatic resolution in the Middle East.
And this brings us to a really wonky but highly consequential debate between outgoing Chair Powell and incoming Chair Warsh regarding how they actually measure the speed of the car.
The methodology debate.
Yes. Kiplinger highlighted that Powell has historically favored the PCE, which is the Personal Consumption Expenditures Index, but Kevin Warsh strongly prefers trimmed mean averages. Let's demystify this for people. Why does a statistical methodology debate matter to a listener who's just trying to budget for groceries?
It changes everything about how the central bank reacts to your pain. A trimmed mean average takes all the price changes in the economy over a month, and it literally chops off the extreme outliers on both ends. It strips out the highest price spikes and the deepest price drops.
To eliminate the noise, supposedly?
That's the theory. Warsh's argument is that if egg prices jump 50% because of an avian flu outbreak, or gas spikes 21% because of a naval blockade, well, those are temporary geopolitical shocks. They don't represent broad, underlying, systemic inflation.
So you just ignore them?
By trimming them out, yes. The Fed gets a cleaner look at the core economy.
But I'm looking at this from the perspective of a commuter. I don't get to trim gas out of my household budget.
No, you absolutely don't.
I still have to buy the eggs and put gas in the car to get to work. If the Fed looks at a trimmed mean index, sees a clean 2% number, and declares victory over inflation, while I'm paying $4.18 at the pump, that creates a massive psychological disconnect.
It creates a massive crisis of institutional credibility. The consumer feels suffocated while the central bank is taking a victory lap based on sanitized data. And that is exactly the philosophical shift we are going to see under Warsh.
And this policy paralysis isn't happening in a vacuum either. While the U.S. is trapped by fiscal dominance, the rest of the world is buckling under the pressure. Look at the Bank of Japan today.
Oh, the BOJ is in a terrible spot.
They held their interest rates at a microscopic 0.75%. But it wasn't unanimous. 3 board members formally dissented, arguing they needed to hike rates to 1.0%. Why? To fight imported inflation.
This is where the global currency markets come into play. Japan is an island nation that imports virtually all of its energy, and oil is universally priced in U.S. dollars. So when crude hits $100 a barrel, Japan doesn't just suffer the price increase of the oil, they suffer the exchange rate penalty.
Because they have to sell yen to buy dollars just to be able to buy the oil.
Which heavily devalues the yen. The U.S. is holding rates at roughly 3.50%. Japan is at 0.75%. That massive yield differential means global capital flows out of Japan and into the U.S. seeking a higher return.
Right, the carry trade unwinds.
Exactly. The U.S. dollar acts like a wrecking ball, crushing the yen, which makes Japan's energy imports even more expensive, creating this vicious inflationary spiral for their domestic economy.
So if the U.S. maintains this higher for longer stance, we essentially export our inflation to the rest of the world.
Yes, we do.
And that systemic stress is exactly what Jamie Dimon was warning about today. The JP Morgan CEO issued a stark warning about an impending downturn in private credit markets, directly citing these geopolitical risks and the massive U.S. deficit. When the head of the largest bank in America is telling you that the structural foundations of private credit are shaking, you really have to pay attention.
Private credit has ballooned over the last decade because traditional banks tightened lending standards. But a lot of those private loans are floating rate 9. As the Fed holds rates higher for longer, the interest expense for mid-sized companies carrying that private debt is becoming totally unmanageable. Diamond sees the defaults coming.
Okay, we've covered the $600 billion AI infrastructure bill, the physics of oil well shut-ins, and the mathematical trap of fiscal dominance.
A lot of macro.
It is. But how is this actually playing out on Main Street? Because the data from Chartmill today reveals a historic, almost unbelievable split-screen reality. We're looking at one of the most bifurcated economies on record.
The macro data suggests a stable economy, but the micro experience is entirely dependent on your leverage and your pricing power.
The consumer sentiment data perfectly illustrates this. The Conference Board Index, which largely measures how people feel about their current employment situation, actually rose to 92.8. And that tracks with the data. 178,000 jobs added, 4.3% unemployment. People aren't necessarily terrified of getting laid off tomorrow.
Well, look at the University of Michigan data.
Right. The University of Michigan Index, which measures how people feel about their financial future and their purchasing power, plummeted to a record low of 49.8. One-year inflation expectations just hit 4.7%.
It's the difference between having a job and having a livelihood. You are employed, yes, but your paycheck buys slightly less every single week.
You're running in a treadmill.
Exactly. Your standard of living is slowly eroding beneath your feet. You aren't in a recession, but you feel like you are losing ground.
And while the consumer feels like they are drowning, certain corporations just posted earnings that look like they are operating in a completely different dimension.
Because they possess the ultimate economic shield, pricing power.
Let's dissect the Starbucks earnings, because this is a masterclass in corporate maneuvering. They posted an absolute blowout quarter today. Under CEO Brian Niccol, they reported a non-GAAP EPS of 50 cents, completely crushing Wall Street estimates. U.S. comparable store sales rose 7.1%.
Incredible numbers given the environment.
But here's the structural genius. They classified their entire China retail operation as held for sale. By carving out that struggling international segment, their operating margins instantly jumped to 19.4%.
It's brilliant financial engineering, but it also reveals an inelasticity in consumer behavior. Despite feeling squeezed by 4.7% inflation expectations, the American consumer is still somehow prioritizing a $7 iced coffee.
They won't give it up.
No. Starbucks realized their product is treated as an essential daily luxury. They keep raising prices to offset their own supply chain costs, and the customer just absorbs it.
We saw the exact same phenomenon with Visa today. They beat expectations with $11.23 billion in revenue, fueled by a massive 23% jump in Visa Direct. People are swiping their cards more than ever. Coca-Cola beat estimates entirely by flexing their pricing power on zero-sugar products.
Everyone is passing the buck.
They charge more for the syrup, the bottler charges more for the can, and the consumer just pays it.
But notice who didn't win today. Booking Holdings.
Right. The travel giant beat their Q1 estimates, but their stock took a major hit because they actively lowered their forward guidance. They explicitly cited the conflict in the Middle East disrupting global travel corridors.
Which perfectly defines the dividing line in this split economy. If your business model relies on moving physical human beings across geopolitical borders, or if you rely on cheap floating rate debt to fund your operations, you are in deep trouble.
You can't escape the macro environment.
No. But if you sell a highly addictive low-cost luxury, or if you run the digital toll booth on every financial transaction like Visa, you are insulated.
Big corporations have essentially figured out how to pass 100% of the macroeconomic pain down to the middle and lower class consumer. It's an incredible transfer of friction.
The U.S. exceptionalism trade is fully intact for these mega-cap brands. They have the scale to defend their margins in a way a local small business simply cannot.
Which brings us to the single most perplexing data point of the entire day, the precious metals paradox.
This is fascinating.
Let's summarize the board for a second. We have a major war blocking 20% of global oil. We have WTI crude at $100. We have 4.7% consumer inflation expectations. We have a fracturing OPEC and a Federal Reserve trapped by $30 trillion in debt.
Mhm.
Historically, traditionally, textbook economics says that in this exact environment, gold and silver should be launching to the moon as the ultimate safe haven inflation hedge assets.
But they absolutely collapsed.
They fell off a cliff. Gold dropped over 2% to around $4,570 an ounce. Silver plummeted nearly 3% to $73.42 an ounce. The gold-silver analysis notes that this price action is completely counterintuitive. What is the mechanism driving this? Why are the ultimate inflation hedges failing right when inflation is accelerating?
It comes down to a mathematical concept called real yield pressure. This is the invisible gravity of global finance.
Explain the math behind real yield for us.
The real yield is simply the nominal interest rate of a safe bond minus the expected rate of inflation.
Okay.
We know the 10-year Treasury is yielding a nominal 4.352%. Because the Fed is trapped and forced to hold rates high, that yield is highly attractive to a large institutional fund. If the expected inflation rate is roughly 3.3%, the real yield, the actual purchasing power gain, is positive.
So an institution can park billions of dollars in U.S. government bonds and guarantee a positive return above inflation.
Exactly. Now, compare that to gold. Gold pays zero interest. It has no dividend. It has no yield. When the U.S. dollar is surging globally because of the BOJ struggles and U.S. treasuries are paying high risk-free yields, the opportunity cost of holding a zero-yield asset like gold is simply too high for institutional algorithms. They sell the gold to buy the bonds, driving the price of the metal down.
But silver fell even harder than gold. It dropped 3%.
Because silver suffers from a dual personality. It is a monetary precious metal, sure, but it's also a highly sensitive industrial metal.
Oh, right.
It is vital for solar panel manufacturing, electric vehicles, and high-end electronics. When the market sees $100 oil, it assumes a massive slowdown in global industrial production because factories simply can't afford the energy costs. So $100 oil acts as a severe industrial headwind for silver, crushing its price, even as its safe haven appeal is neutralized by the high treasury yields.
It's wild because if you look at the physical fundamentals, silver should be skyrocketing. The gold-silver report highlights an incredible structural deficit. Since 2021, there has been a 762 million ounce drawdown in global silver inventories.
It's a massive shortage.
The world is physically consuming far more silver than we are mining out of the ground. The physical fundamentals scream shortage, but the paper market, driven by geopolitical panic and bond yields, is pushing the price down.
And in the short term, the bond market always wins. Liquidity dictates price, not physical reality.
I want to bring this entire deep dive full circle back to where we started with technology. Because amidst all the discussion of inflation, credit card swipes, and corporate resilience, Visa's earnings call included a phrase that I think acts as the keystone for this entire murky diagnostic landscape. They credited their massive future growth potential to something they called agentic commerce.
Agentic commerce. The transition from AI as a chatbot to AI as an active, autonomous participant in the economy.
Yes. The idea that AI agents' personal bots will automatically negotiate and execute purchases on behalf of human users. Your smart refrigerator detects you are out of milk. Your personal AI bot scrapes the internet, negotiates the absolute best price, and uses your saved Visa credentials to purchase and ship it, all without you ever lifting a finger or looking at a screen.
It is the ultimate manifestation of the $600 billion infrastructure build we discussed at the top of the show. It's the transition from a novel software tool to a fundamental layer of daily economic activity.
So let's synthesize this incredible web of connections we've covered. We started with the AI monetization gap. The market is demanding that OpenAI and the semiconductor giants prove they can generate actual, tangible software revenue to justify their $600 billion hardware investments.
Right, and that reality check triggered a massive sell-off in the NASDAQ today.
Which pushed capital directly out of Silicon Valley and into an energy sector that was simultaneously being rocked by the UAE's historic exit from OPEC.
And that exit signals the end of managed global oil supplies, just as the Strait of Hormuz blockade physically cuts off 20% of the world's crude.
That blockade, and the physics of Iran's impending well shut-ins, pushes WTI oil over $100 a barrel. That localized shortage ensures that global inflation stays hot and sticky, which in turn completely handcuffs Jerome Powell in his final Federal Reserve meeting.
He is totally trapped.
Trapped by the mathematics of fiscal dominance, unable to hike rates without blowing up the national debt, and unable to cut rates without exploding inflation further.
And those high interest rates create the positive real yield that crushes the price of gold and silver, while the strong U.S. dollar wreaks havoc on the Bank of Japan and global currency markets.
And locally, it terrifies everyday consumers who are paying $4.18 for gas, driving consumer sentiment to record lows. But paradoxically, it rewards massive, cash-rich corporations like Starbucks and Visa who have the pricing power to just pass the inflationary friction entirely down the line. It is a breathtakingly complex machine. And for you, the listener, surviving this economic era requires looking past the headline noise.
You have to track the structural why.
Exactly. If you want to understand why your tech portfolio is suddenly volatile or why your mortgage rate is stuck at 7%, you have to follow the real yield in the bond market, and you have to understand the mathematical trap of fiscal dominance. Once you understand those mechanisms, the daily volatility stops feeling random.
You stop reacting to the noise and you start seeing the underlying currents.
I want to leave you with a final provocative thought to mull over. We just talked about Visa and agentic commerce, this impending future where AI bots are doing the bulk of routine household shopping. But think about the economic data we've discussed today. The Conference Board, the University of Michigan's sentiment surveys, the CPI. If we are heading into a world where AI agents are making millions of daily purchasing decisions based purely on algorithmic price optimization, how will the Federal Reserve even measure consumer sentiment 5 years from now?
That is a staggering thought.
Yeah.
It fundamentally changes the definition of a market participant.
Are we going to have to survey the bots to see how they feel about inflation? If an AI agent is dynamically buying my groceries and optimizing my budget across a dozen different retailers in milliseconds, does the bot care if the price of eggs jumps 50%? Will Kevin Warsh's trimmed mean averages be calculated by an AI that doesn't actually feel the physical pain of a $4.18 gallon of gas?
Central bank will be trying to measure human psychological distress in a market dominated by emotionless algorithms.
We are looking at a diagnostic landscape that is incredibly murky, and the image isn't getting any clearer. The plates are shifting, the energy maps are being violently redrawn, and the very nature of who or what does the shopping is fundamentally changing. The picture might be muddy, but by tracking these deep currents, you can start to read the shadows. Thanks for taking the deep dive with us today.